Hey everybody, welcome back to The Long Game. I'm Brent Schafer. Along with me is Tyler Pearson. We are both certified financial planners at HFG Trust, sharing conversations that we're having with our clients, reminding them to think about the long game. Tyler, how you doing?
Good, Brent. Good. You're looking pretty stylish, if I may, like the HFG Trust swag. That's a no shame segue into today's topic of style boxes. But
Perfect. I was trying to figure out where you were going there, but okay. So the
slow
topic
clap.
for today, we brought it up in a previous episode, talking about the Morningstar Style Box. Tyler, why don't you fill us in on what a style box is and what it's used for?
Yeah. So style box is a real good way to look at a portfolio and some of the attributes of what exact investments are within the portfolio. So kind of where it might tilt. So if you look at the equity side, on the left side, you're going to see the small, medium, large, large, medium, small going from top to bottom. That is the size of the stock based on market cap. So large would be a large cap, and I think Brent has the actual numbers he can touch on. And then going across the bottom, we have value, blend, and growth. One of the more common metrics used there is going to be the price to earnings ratio. Value is going to have a lower price to earnings ratio than growth.
Well said. Yeah, I think that sums it up. And Morningstar's exact definition, they publish it, and you kind of have to really search it out to be able to find it. But I'm believe that it's based on market cap percentage, being so large as in the upper 70% of market cap, medium is 20, and then small is that lower 10%. And then talking about the fixed income style box. So we've got high, medium, and low, and those are in terms of credit quality. So again, high credit quality, it's investment grade, highly rated debt, probably not going to default, very, very low default risk. And then as you get into low credit quality, more likely that you're going to default. And then short, intermediate, and long, those are based off of duration. So short duration is 3.5 years or less. Intermediate or midterm is 3.5 to 6 years of duration, and then long is anything greater than 6. These style boxes are just really a quick way for financial professionals to be able to tell where the fund is invested and what makes up the components of the fund, truly. So next, Tyler, I want to share, we've just got 3 funds here real quick. And now that we know where style boxes or how style boxes are used, we can show them how you and I take a look at this. So this is VU, Vanguard's S&P 500 ETF. S&P 500 are the 500 largest companies in the United States. So as we would expect, a lot of the fund is made up of those large holdings. You can see here, let's do some quick math. 82% of the fund is in the large tranche. And then there are some that are mid and 1% small. What do you think that's all about there?
Oh man, somebody must have had a rough year in terms of market price. There could be a couple other reasons for it, but my guess would be that there's a company whose market cap fell drastically. Yeah, and S&P 500, I would imagine it was quite the fall.
Yeah. Okay. Let's see. Next we've got here is the iShares Russell 2000 ETF. And the Russell 2000 are essentially the smallest 2000 companies really reflected here. So that's what you can see. Small value, 34%, small blend, 31%, small growth, 29%. And I think right now I want to talk a little bit about that blend category. So there are also style boxes out there that are just really 4 quadrants, right? So it's small, large, and then value and growth. And so Morningstar, they have that blend category, which these companies, based on some of the metrics that they use to quantify them, well, it could be right now they're a little bit in column A, a little bit in column B, so they kind of blend them together because they kind of have a mix of both characteristics. At the end of the day, you kind of have to draw a line down the middle, but we've got that neat little blend category. And then lastly, we've got State Street Spider S&P 1500. So this is the S&P 500, the 400 mid cap, and the 600 small cap all added together. And it's a fairly decent size of the market, 1,500 companies. You can see it's still predominantly large based, but there are more companies, in the mid and small range. Uh, when we've talked about this in the past, that's one of the things that's really impressed. Well, I don't know if impressed is the right term, but just giving you pause on like, wow, I didn't know that it was, like that. So we've got S&P 500, obviously tilts large, straight out. But then when we take the 1,500, it still tilts large, and we add in 1,000 extra companies, and does it bring the average down? Yes, it does, but not drastically like you would think. So
Yeah,
I don't
I
know.
think
Anything you want to add, Tyler?
yeah, I would just say it's a good point, and it's largely really what it does for me is it highlights how large the largest companies in the world are, especially today. For 500 of the companies to still make this box tilt that heavy to large after you added in 1,000 companies really does highlight how large the S&P 500 is. And if you were to get really nitpicky and break it down, the top 100 companies in the S&P 500, you'd be blown away how much of the S&P 500 is made up of just those 100 companies when you look at it from a market cap perspective.
So I think I want to tie it back to what we were talking previously when it came to target date funds. And ultimately, the conclusion that we came to was if you're not going to dedicate time or consult a professional to pick your investment allocation, target date funds are a good option. It's kind of a vanilla investment product, but you follow a glide path, and retirement is the objective in mind when they're investing those funds. Now, when we use a Morningstar Style Box, we can basically take the market, the funds available to every investor, and really tilt things to areas of the market that historically have performed better than other areas of the market. And there are lots of white papers, lots of research on those specific things, but I think I just wanted to compare and contrast the options that are out there. First being, you use a target date fund, or second being you have a list of funds and you can kind of set up your own allocation and own portfolio tilts. If you think it's value's going to outperform or growth's going to outperform, or large has had its big old run up, or small. So anything that you want to add on that?
No, I think I would just ask the question. You touched on it briefly a couple minutes ago, but just what are you using a style box for in your day to day?
Yeah, and really it would be to break down investment portfolios that I see for current clients and potential clients as well. It's one thing that you can do at a macro level to really see where they're invested. I would say that, that's probably the first layer that you would use. And then from there, you can go deeper into asset class. You can look at United States versus international versus emerging markets. That's really where, we start to use it and start to take a look at, is there any concentration risk? And we've talked about it before, concentration risk and diversification, and they are all relative terms. I'm certain that you can find a fund that is probably in exclusively in large growth, or at least very, tilting that side. And so the style box just allows us to get a quick kind of temperature or pulse check on where the portfolio is allocated today, and then you use that information to dig deeper. So, yeah, anything you would like to add?
No, that's exactly what I'm using it for. It's a combination of client portfolios, prospective client portfolios, and fund research. And again, it's a macro level thing. I think it's interesting. I think it's something that can be beneficial even to people who aren't well studied or well versed in the investment world. It's a nice, easy to the eye way to see where your investments fall.
Yeah, and just as you were talking about it, I think we were using it as more so a forward-looking approach. You can also use it as just kind of seeing recent history, right? So if somebody is coming off of like, and let's just pick on large growth, for example, if they're isolated or concentrated in large growth, you can see that on the style box. And that also indicates like, oh, hey, you were invested in some of the assets and sectors and areas of the market that have outperformed. So yeah, you did a good job. Or, it's kind of a reason that people are proud of their returns. And, then we can pull up all matter of charts, right? JP Morgan guided the markets on just how predictable certain areas of the market are to perform or be the top performers on any given year. But we could talk about that during future episodes, Tyler. So any final thoughts? Anything else you'd like to add before we close it out?
No, I think we covered it all.
Okay. Well, thank you very much for joining me, Tyler. I hope that the folks at home know a little bit more about Morningstar Style Boxes. And if you've got questions or want to run through of your portfolio, Tyler and I are both happy to do that. Feel free to send us an email or give us a call. All right, everybody. Thanks for watching. We'll catch you later.